Something incredible has just occurred on the US stock market. Something that over the last 50 years of data we've only seen happen once, and that was in June of 1987. To understand exactly what's similar about both of these instances, we have to look at an indicator called the McClellan oscillator. It just did something quite rare in the month of May, going from an extremely low reading of -100 to an extremely high reading of 50 in a very short period of time. Over the last 3 years, we've only seen that happen twice. Once here in October of 2022 and once here in April of 2023. If we add the S&P 500, we can see both of these instances led to additional upside on the stock market. This McClellan oscillator is a measure of the momentum of the breadth of the stock market. Now that sounds complicated, but it basically shows how quickly many stocks are going up or how quickly many stocks are going down. So the signal that we have today is basically telling us that the market went from an extreme level of fear and capitulation with most stocks going down very rapidly to significant optimism with most stocks going up very rapidly. And since 1980, we've only seen this signal occur 21 times. And you can see all of these readings right here. In just one of these 21 readings, did the market drop immediately following the signal. The rest of the 20 signals led to the market moving higher within the next 60 trading days that followed. In fact, the average percentage gain that we saw following these readings was a massive 11.3%. Now, 3 of these 20 signals only led to short-term rallies followed by considerable drawdowns. That was the case, for example, in August of 2007, the market rallied around 10% to the final high in October before beginning a large bear market. In 2002, the signal occurred at the beginning of a large bounce in the market. The S&P 500 rallied another 10% before again reversing lower. In 1987, the market was in a massive melt-up, and the signal occurred right before the market moved another 15% higher and eventually led to the famous 1987 flash crash. But all 3 of these readings did lead to the market moving up by around 10% within the next 60 trading days. So to summarize, if we respect the historical odds, there's a 95% chance that this reading will lead to an additional 10% upside within the next 60 trading days. And there's a 5% chance that this reading is going to be followed by a large drawdown like in 2007. But this reading from 2007 is probably one that we can completely eliminate because it happened under very specific circumstances at the heart of the financial crisis. The stock market had already collapsed by 45%, and this signal was triggered during a counter-trend bounce before investors started to dump stocks again. We can definitely say that today's situation is quite a bit different to that reading that we had in November of 2007. But there is something very peculiar about the reading that we have today. It occurred in May when the stock market was around 25% higher than its 100-week moving average. Now that basically means the market was already very elevated when the reading occurred. As you can see, that's quite uncommon. Most of these readings occur when stocks are around their 100-week moving average. The signal from the McClellan oscillator tells us that the market has capitulated and then recovered fully from that capitulation. Typically, capitulation only occurs when the market has been moving down quite substantially, and so stocks are a lot closer to their long-term moving averages, or even in some cases below their long-term moving average. That's not at all the case with the reading that we just had today. Going back all the way to the 1980s, we've only seen this happen once. And as you probably knew from the title of this video, that was in June of 1987, where this reading on the McClellan oscillator was also triggered when stocks were already 25% above their 100-week moving average. Now, arguably, this wasn't such a great signal to be entering the stock market, as you had a very severe 35% drop on the S&P 500 in the months that followed. That said, what's interesting about this signal is a successful signal for the market in the short term, leading to an additional 15% upside over the next 60 trading days. So is that what's in store for the S&P 500 today? A 15% gain over the course of the next 60 trading sessions would take the S&P 500 to 6,000 points by August of this year. Now that may sound crazy, but since this reading has occurred on the 3rd of May, the market is already up 3.5%. Another 15% rally on the S&P 500 would take the Shiller PE ratio to around 40, the most expensive level for stocks since 1999, which sounds completely ridiculous. Consumer confidence today is at one of the lowest levels in history. This is a level that's comparable to the pessimism that we saw in 2008 during the financial crisis and in 1980 when inflation was at 15%. People do not feel optimistic about the future of the economy today. And this divergence between the stock market and consumer confidence is something that's been building to a historical degree since 2020. You can call this a K-shaped recovery where Wall Street has been doing great, but the average person has been suffering. We also don't think that this is going to gradually come back to reality. Seeing the stock market reach exorbitant valuations before Wall Street finally comes back down to reality is something that actually seems to be playing out today. We're going to be covering this every step of the way at GameOfTrades.net and preparing our clients to profit and protect themselves as much as possible from these developments. So if you haven't already, get yourself a membership on our website.